Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Dave Kranzler. And Dave, for those of you who may not have heard of him in the past, he spent a bunch of years on Wall Street. He worked as a junk bond trader at Bankers Trust, and has a degree, a business degree, an MBA, I suppose it is, from the University of Chicago, and concentrated in accounting and finance. And so he currently manages Golden Returns Capital. It's a precious metals and mining stock investment fund based in Denver. So clearly Dave and I have a lot in common in terms of our investing interests. And he writes a very, very good blog, a very interesting blog that really keeps you up to date with some of the things that are going on, not necessarily the things you're going to hear about, or at least the perspective that you're going to get from the mainstream media, but one that I think is refreshingly honest and one that would really be worth your while checking out. And you can do that by going to investmentresearchdynamics.com, investmentresearchdynamics.com. Welcome, Dave. Thanks for joining me again.
Hey, thanks for having me, Jay. It's always a pleasure to chat with you.
Always a pleasure to talk to you. You were in that mile-high city of Denver. Now, on October 6th, I really want to do is ask you about a few of the things on your blog, and maybe this will give our listeners a sense of why they should go there. But you wrote on October 6th an article titled "A Liquidity Crisis Hit the Banking System in September." And you showed a chart there, I think it was from Federal Reserve data, that showed an alarming amount of Treasury reverse repurchase activity by the Fed that has been massively larger. I mean, it's been taking place in 2014, 2015, but really skyrocketed recently in 2015. But all of this activity is substantially greater than what looks like a molehill by comparison in 2008, when the Fed stepped in to try to soothe the markets when they were going to hell. For the sake of our listeners, first of all, can you explain the reverse repo market? Just explain what it is, and what is the nature of the transaction.
Sure. Just real quickly here, it's actually just the opposite of a repo market transaction. It's open market operations conducted by the Fed, and the primary objective is just to sort of manage the federal funds rate. So if they think that there needs to be more liquidity in the system on a short-term basis in order to keep the Fed funds rate down, or in its target range is 0 to 0.25%, then what they do is they go and they solicit repo transactions whereby they lend cash to the banks, and the banks collateralize those cash loans with treasuries. Then the reverse repo, just to point out, it was actually called, that's a temporary repurchase agreement. The permanent open market operations are what they used to implement their QE, where they go in and they print money. Mm-hmm. And then they use that money to buy treasuries from the banks, which have bought treasuries from the government as the government issues them. So, I mean, it's primarily used for short-term interest rate management, but it can also be used to inject permanent liquidity into the system. And the reverse repo technically is just the opposite of that. Fed funds rate is in danger of slipping below 0. So what they do is they go and they take cash from the banks and give the banks treasury as collateral in exchange. So now, and it often happens at the end of the quarter, and a lot of people have kind of pointed this out about my analysis, and there is some degree of validity to it, but not in the context of the spikes that you see on that graph. And that is, at the end of the quarter, banks don't want to show a lot of uninvested cash on their balance sheet. So if they have a lot of cash, what they'll do is the Fed will do a reverse repo with them, where the Fed sticks treasuries on their balance sheet, and the banks collateralize those treasuries with the cash that they have. And then after the quarter's over, they'll unwind it. But that way, on say October 30th or September 30th, when the banks have their quarterly audit done, they can show a lot of treasuries earning a little bit of interest on their balance sheet rather than cash, which is earning basically nothing. Mm-hmm. Now, the thing of it is as you pointed out, I mean, since the beginning of 2014, I mean, that reverse repo graph looks like, the heart monitor of someone on meth.
Yep.
And the spikes keep getting larger. And so what I would suggest, and I can't take credit for finding this. A good friend and colleague of mine had pointed this out to me at the beginning of the year when he was bored at work and just started thumbing through Fed graphs, and he found this reverse repo that shows the big spike up right before the beginning of 2015. And it happened to coincide with a period of time when several of us, I think we probably have talked about this in the past in emails, Jay, and I know John Embry sort of independently noticed the same thing. It was right around the middle of December. It felt like precious metals were behaving a little bit differently, and it also felt like that something had happened, like some sort of derivatives accident had happened behind the scenes that was being monetized, because the stock market also got a little more volatile, and it just sort of felt like something was wrong out there, and it also felt like the economy really slowed down. And it just so happened, there was a reverse repo that occurred at quarter end, but it actually started in the middle of December, the reverse repo process. And if you look, I mean, it's the second biggest, highest spike on that graph. And these spikes are so beyond what the average little bump up might be for quarter end. I mean, they're even way beyond what, as you pointed out, what occurred in 2008. Mm-hmm. And so I don't think the quarter end bank balance sheet management explains it. I don't even think it explains 10% of that spike, especially considering that each time, at least the two largest ones on there, a fairly large percentage of the reverse repos were done with foreign banks. And so what I think may have occurred is what happens is these banks all have exposure to derivatives. And so if you're on the wrong side of a derivative, you either got to close it out or you got to post collateral. And treasuries are what's used for collateral globally in terms of posting collateral against losing derivatives trades. And I'm not suggesting that necessarily the banks per se are the ones in the losing position, but what the banks can do is they can take that treasury collateral that they get with from the Fed and hypothecate it to hedge funds and other pools of money that may have losing derivatives positions in which they need to post collateral. I mean, if a bank has cash on its balance sheet, it's not going to give it to a hedge fund. Here, go post this as collateral, but you can hypothecate treasuries as collateral. And I think that's what's being done. It just so happens that spike, the big one out there in the yellow circle, that one started on September 16th. Well, that also happened to be right when Glencore stock started blowing up. And so, to me, could it be coincidental? Sure, anything's possible. But Glencore is a roach motel of leverage and derivatives issues, and we don't even know the tip of the iceberg there. And there's no telling what's going on. But obviously, they're exposed to all the markets that have gotten hit hard: industrial metals, energy, and precious metals. So to the extent that they've got derivative trades on that expose them to the downside of those markets, I mean, there's no telling, how far off sides their liquidity situation was, or is, or could be.
Right. So the banks could have taken the wrong side of the trade and really be in trouble on some of those things.
The banks could have taken the wrong side of the trade. It could be hedge funds. I mean, it could be. To me, it suggests that something occurred that was would have been more damaging than might have been something that occurred in 2008 if they didn't do something to address it right away.
Right. So they got out ahead of it to make sure we didn't get another 2008, perhaps. They tried to.
Eventually, I think they're not going to be able to do that. But I think that's probably what happened. I mean, and also we know Deutsche Bank's in a very compromised position right now, and we don't even know, 5% of what's going on there. I mean, they gave us a preview of a $7 billion quarterly write-down that was largely goodwill and non-essential items. I mean, what I would really like to see is I'd like to see what their derivatives positions look like. And I think the rest of the world would too.
Yeah, that'd be very frightening potentially. So maybe we don't want to see it.
Hey, it's Halloween. I want to see it.
Yeah. Okay. Yeah, Halloween's approaching. Well, in all seriousness, though, I mean, this is scary stuff. I mean, I would. So let me just. I want to make sure that I understand this, Dave. What would the Fed be trying to do here then? To lower rates, or to keep that rate level, that Fed funds rate between 0.25%? Is this suggesting that they had to try to pull rates up or push them down?
Actually, that's a good question. Let me clarify this. If I'm right about this, and I'm not saying that I am, we can't know what's going on behind the wizard's curtain.
Sure.
But this operation is not about short-term interest rate management. This is an operation that's designed to force collateral into the market that can be used as collateral against losing derivatives positions, so that those derivatives positions don't have to be closed out, and then all of a sudden there's counterparty default risk that triggers.
Right.
So in other words, I mean, it's well known that there's a pretty extreme shortage of Treasury collateral out in the global marketplace.
Yeah.
And a big reason for that is, I mean, the Fed owns in some maturities, the Fed owns half of the Treasuries outstanding. I think the 10-year, I think they own like half of them outstanding, something like that. Don't hold me to those numbers, but it's of that scale.
Mm-hmm.
And so you have all this Treasury collateral sitting on the Fed's balance sheet, and so this operation is designed to get that collateral out into the marketplace so that it can be hypothecated and or rehypothecated, so that people who need treasuries to post as collateral against losing derivatives positions can post that collateral. Yeah. And guess what? We saw Glencore's stock miraculously bounce shortly after it hit, I think it was basically its all-time low. I mean, I have the numbers on one of these articles in my blog, but it was down something like 50% in a very short period of time recently, and then all of a sudden it bounced, as did some of the industrial commodities markets that it's exposed to. And I honestly, I think that was probably the central banks coordinating a bounce to try and calm those markets down, and try and address whatever happened behind the scenes that caused that reverse repo spike.
Well, it would certainly make sense. I mean, these guys have learned a lot from the past and probably are anticipating, similar problems. I think it was Larry Summers just yesterday or the day before was out there talking about how another 2008 could develop, So clearly the big boys are aware that we've got some underlying problems, to say the least, and that would all make a lot of sense. I would just tell my listeners it's October 6th is the article. Dave, they can still read this article there, I guess. It's still posted there, right?
Yep.
And it stays up there for quite a while, so people can go to investmentresearchdynamics.com to pick up on this. So if it's the sort of thing you care about and you like to understand, try to understand. I think this is really, really important stuff, Dave. I want to thank you for that. Now, we have a few more minutes left yet, but there's so many other things to talk about. Would anything else you'd like to say about that article?
No, I mean, I think I have most of it in the article. I've been meaning to go back and add a little bit to it to address the people who have commented either on my blog or via email that, maybe this is just the quarterly balance sheet dressing that they do with the banks, and it's not. I mean, those spikes are way too much of an outlier.
Sure.
To be sort of the normal quarterly balance sheet window dressing that they do with the reverse repos.
Yeah. Very important stuff. Thank you for that. You also had an article on the following day. Something blew up in the global financial system. I think you were maybe talking about Deutsche Bank there as well. You just commented on that. So Deutsche Bank's balance sheet as toxic waste is an article you put out on your blog on the 9th. Can you talk to us a little bit about Deutsche Bank's balance sheet, what you know about it?
I mean, I don't think any of us can really know a lot about Deutsche Bank.
They don't tell us, do they? It's a funny thing.
How do. I mean, you look at a bank balance sheet, and if you dig through the footnotes, you can get a little more out of it. But if you look at their asset base, like when they show their assets, which are primarily loans, okay, the areas where they're exposed to industrial commodities, oil, emerging markets and emerging market currencies, Volkswagen, suppliers to Volkswagen. They're a big creditor of Glencore. And so in terms of the high yield market, they are a huge lender to the leveraged loan market. So companies that are rated as high yield, junk bonds, Deutsche Bank lends to them. That's why they bought Bankers Trust. They wanted that business. and it just so happens all of those asset classes have gotten annihilated in the last 3 to 6 months. So for Deutsche Bank, if they've got a $1.5 trillion balance sheet, for them to come out and say, oh, well, we're going to take $7 billion in write-downs in goodwill, I mean, that's a joke.
Yeah.
I mean, and they're now the largest derivatives player. They're bigger than JP Morgan in derivatives.
Wow.
And I think it's also very possible that reverse repo spike could have been related to getting collateral to Deutsche Bank. I don't know. I mean, the banking system is so opaque. We have no way of knowing.
Yeah, and it's just a handful of really big ones internationally, isn't it, Dave? I mean, it's not like your little, your local bank. It's these big money center banks out of New York and London and in Germany and places like that that are really the guys that are playing this, and they have a special route to the Fed and to the other central banks, don't they?
Yes, that's right.
They get bailed out. They can do
out.
all kinds of things that reap huge profits, all kinds of things that are just immoral and illegal and everything else, and make huge profits. And then when the thing goes boom, we all get stuck with the losses. And again, just like we did in 2008, 2009. But just looking at that chart on that article that you put out there, it's frightening. It really is. And yes, we don't know what's on these balance sheets, and they don't mark them to market at all. So God only knows what's going to hit us next.
That's right. But we do know what Deutsche Bank's primary lines of lending are, and it's everything that's gone bad in the last 3 to 6 months.
Yeah. Well.
and that's their on balance sheet. Their $1.5 trillion is what they've got on balance sheet. They've got a whole closet full of skeletons called OTC derivatives, and you can't even get much information on those in their footnotes. And that's the way the law
they're over the counter. They're over the counter. Nothing. Yeah. So look, we only have a couple of minutes left here, but just a couple of more articles I would just mention to my listeners. Systemic leverage. BlackRock calls for pulling the plug on stocks to prevent big drops. Maybe take a minute to comment on that article.
There was a news release last week where BlackRock came out and was proposing that provisions be put in place to let the people running the stock exchanges, basically pull the plug in times of quote unquote high volatility. And by what they mean high volatility, they mean when the market's selling off. If it
goes up, that's okay, but if it's going down, we have to just shut the market off.
Yeah, we didn't see this proposal over the last 5 years when the S&P was basically going up. Up in parabolic fashion. It's right. Now when there's downside risk. And BlackRock is probably, in terms of the United States, they may even be a higher risk entity than JP Morgan. Real quickly, Jay, I did want to mention the junior mining stocks. I think it would be remiss if we didn't chat about
it. Please do.
And I wanted to say that it's been interesting because just in the last 4 to 6 weeks, I offer junior mining stock reports off my blog. And I have not really been promoting the sector, and I haven't written any new ones recently. I've got 2 on there that were updated in August. But just in the last 4 to 6 weeks, I've had several readers come into me and ask me about my research reports, and I've actually sold quite a few over the last 4 weeks. And to me, when people started coming into me, my antenna went up, and there's definitely a bid. The market definitely has a bid right now in terms of...
All right, very good. Unfortunately, Dave, we're out of time, but people can go to your website there, investmentresearchdynamics.com, and you sell these piecemeal, don't you?
Yes.
Okay, very good. Well, people can do that. You don't have to subscribe to David's letter. You can buy them piecemeal, unlike mine. But yeah, I'd love to talk to you some more about the mining sector, because I think Kevin Duffy made some very good comments. That he believes that Newmont, for example, is turning around. Very constructive on Newmont right now. We are basically out of time. I just want to tell, there's so many articles, folks. Go to Dave's website to read them. Systemic leverage. Another one is Japan Inc. pulling out of the COMEX and LBMA. Here comes pension fund benefit cuts. Bank sovereign deception. Bernanke lied and should go to jail. John Titus comments, criminals are running the Fed. The low housing inventory. We may be in for some big housing problems again. The low housing inventory myth. Anyway, it goes on and on. So much from Dave Kranzler. Dave, I want to thank you very much for being with us again, and we'll look to do it again sometime in the near future. Thanks so much.
Thanks for having me, Jake.